Today we are going to discuss about an approach of capital structure, and that approach is approach. Modigliani and Miller developed a hypothesis which fundamentally affects the understanding of effect of gearing. Gearing is nothing but the use of debt and equity simultaneously in the formation of capital structure. Though hypothesis is identical with the net operating income approach if taxes are ignored. However, when corporate taxes are assumed to exist, their hypothesis is similar to the net income approach. Approach is basically based upon certain assumptions, and these assumptions are that there are no corporate taxes. This assumption is being used in the approach when the taxes are being ignored. Second assumption is there is a perfect market. Third assumption is investors are termed as rational because they prefer more profits than the less profits, and they prefer less risk over the more risk. Now the fourth one is that the expected earnings of all the firms have identical risk, and the next assumption is that all earnings are distributed to the shareholders. Now let's move towards the theory of irrelevance. The theory is termed as the theory of irrelevance in the absence of taxes. Now let's understand this theory by using a model. Now we have got two models, wherein the upper one is model and the lower one is net operating income approach model. You can easily see that the model is very much identical to the net operating income model. The theory proves that the cost of capital is not affected by the change in the capital structure, or say that the debt equity mix is irrelevant in the determination of the total value of a firm. That is why the theory is termed as the theory of irrelevance, because the capital structure is irrelevant towards the cost of capital and the value of a firm. Here KE sign is used to denote cost of equity. We have denoted sign KD for cost of debt and KO for overall cost of capital. The reason behind the irrelevance of capital structure with the cost of capital and the value of firm is that the debt is a cheaper source of finance to equity. With the increased use of debt as the source of finance, the cost of equity increases. Here you can see in the model that the cost of equity is increasing, and the reason for the increase in the cost of equity is increase in the financial risk of the investors. This increase in the cost of equities offsets the advantage of the low cost of debt, since debt is available at a lower cost of suppose 10% and equity is available at a higher cost. Thus, although the financial leverage affects the cost of equity, the overall cost of capital remains constant. You can see that up till now, the approach is just similar to the net operating income approach. In the net operating income approach as well, as and when we increases the leverage, the cost of debt remains constant, while the cost of equity keeps on increasing. And this increase in the cost of equity just offsets the advantage of the low cost of the debt, and that is why the overall cost of capital remains constant. But after reaching this point, you can easily have a look that after reaching at this point, if we keep on increasing the leverage in the firm, then the cost of debt will start to increase. And the reason behind the increasing cost of debt is same as the cost of equity, and the reason is the increase in the financial risk of the debt investors. So you can see that after point A, even by increasing the amount of debt in the capital structure, the cost of debt starts to increase because of the financial risk. But at the same time, the cost of equities starts to decline, which completely offsets the effect of increasing cost of debt. And because of that, the overall cost of capital still remains constant. So in phase 2, the theory further propounds that Beyond a certain limit of debt, the cost of debt increases, but the cost of equity falls, thereby again balancing the two costs. But the reason behind the declining cost of equity is arbitrage. So to understand the irrelevance of the theory, you must have a basic understanding about the arbitrage process. Now let's discuss about the arbitrage process. Arbitrage process plays a significant role in approach. But before studying the arbitrage process, you should have a basic knowledge about what arbitrage is all about. Arbitrage process gives an opportunity to the investor to earn riskless profit. Another way, arbitrage process gives an opportunity to an investor so that he can get involved in such activity by which he can actually earn profits by incurring less risk in his account, or maybe no risk. According to Modigliani and Miller approach, that is approach, two identical firms in all respect except their capital structure cannot have different market values or cost of capital because of arbitrage process. In case two firms identical in all respect except for their capital structure have different market values or cost of capital, will get engaged into the arbitrage process. As you know that according to approach, the capital structure is insignificant or it is irrelevant towards the cost of capital and the market value of the firm and the price of the shares. But still, arbitrage process plays a very important role while deciding the overall cost of capital of a firm. According to approach, the overall cost of capital remains constant throughout the life of a project irrespective of the capital structure. According to approach, if two firms are identical by nature and they have same profit earnings and they are dealing into the same business but they have different capital structure and they are having different market values or the price of the shares differ in the market, then this situation cannot last long in the market because at that point of time the arbitrage process will take place and the investor will engage into personal leverage, and this will again render the two firms to have the same total value. And because of this, irrespective of the capital structure, the cost of capital of the firm will remain constant. Now with help of an example, let's see how the arbitrage process actually works. Let us suppose there are two firms A and B, identical by nature and falling in the same risk class. The number of ordinary shares for the company A is 1 lakh and for the company B it's 1,50,000. The company A has slightly different capital structure and it has issued 8% debentures, that is 50,000 debentures at the rate of 8%, while the company B doesn't issue the same. As you can see that both the companies have same rate of capital while the capital structure of both the companies is different. Both the companies has a capital of 1,50,000 rupees while the firm B has raised money from ordinary shares while the company A has raised 1 lakh funds from ordinary shares and rest 50,000 from the debentures. The market price per share of the company A is rupees 1.30 while for the company B it's rupees 1. The profit before interest for the company A is rupees 20,000 and for the company B it's same as rupees 20,000. Now you can easily see that both of the firms are identical by nature in terms of their capital and in terms of their profit earnings. Both the firm has same amount of capital, that is 1,50,000, and both the firms have same profits, that is 20,000 each. Now we have to see that how the arbitrage process actually works. Now in opinion of the approach, two identical firms, that is firm A and B, in all respect except their capital structure cannot have different market values. But in this case, these firms are having different market values. In that case, suppose there is an investor who is holding 10% of the shares in company A. Now let's see that how does this investor will get involved into a process of arbitrage to earn riskless profit. Now this investor will sell his 10% holdings in the company A, which is 10% of 1 lakh, and the market price of the shares is rupees 1 and 30 paisa. So the shares which the investor is going to sell in the market will amount to rupees 13,000. Since the market value of the firm A is higher than the market value of firm B, that's why this investor will get engaged into an arbitrage process, and because of the arbitrage process he is going to sell his 10% of the shareholdings which he holds in the company A, which amounts to rupees 13,000. Further, he will raise a loan in the same proportion, that is 10% of the debenture holdings in the firm, which amounts to rupees 5,000 to him. He is doing so to take an advantage of personal leverage as against the corporate leverage, since company B does not use debt content in its capital structure. And from this amount of rupees 13,000, by selling the share of company A, in addition with the loan that amounts to rupees 5,000, which is equals to 18,000, he will buy shares of company B. So now the investor is holding the share worth rupees 18,000 in company B, which amounts to 12% of shares in company B. You can easily see that initially the investor was holding only 10% of the shares in company A, but by involving into the arbitrage process, he is now having 12% of the shares in company B, worth rupees 18,000. Now let us see that does this arbitrage process has an effect on the income of an investor? As you know that the profit before interest of the company was 20,000 for the company A. Since this company is holding 8% of the debentures, that is why the company needs to pay interest worth rupees 4,000. So we are subtracting interest on debentures at the rate of 8%, which amounts to rupees 4,000. So the profit after interest amounts to rupees 16,000, which is ready to be distributed among the shareholders. If the investor who is holding 10% share in the company A doesn't get involved into the arbitrage process, then he is going to get an income of, or the earning per share of, rupees 1600, just because he had 10% of holding in the company. That's why the profit after tax distributed to him will be 10%, which amounts to rupees 1600. Now here the earning available to the shareholders amounts to rupees 1600. Let us suppose if the investor get engaged into the arbitrage process and he holds 12% of the shares of company B, then the profit before interest to the company B is same as company A, that is 20,000. But the company B doesn't have any liability to pay interest to the debenture holders. So we don't need to subtract anything from the available earning, and the profit after interest will be same as 20,000. Since after involving into the arbitrage process, this investor was having 12% of the share in the company B, that's why this 20,000 will be distributed among this shareholder according to his 12% share, that is 12% of 20,000, and he is going to earn 2,400. But this investor has taken a loan amounting to rupees 5,000, and the loan had an interest rate. So we need to deduct the interest paid on the loan at the rate of 8% of 5,000. Since the investor has taken the loan, so he needs to pay this interest from the earning available to him, which amounts to rupees 400. And after deducting this amount, the amount which is left to him, that is net income available to the investor, is 2,000. So by getting involved into the arbitrage process, the income of the investor has been increased from 1,600 to rupees 2,000, and the arbitrage process will continue till the prices of share of company A will fall and that of company B will rise, so as to make the market value of the two firms identical. So according to the approach, the capital structure is irrelevant towards the cost of capital of a firm, because if there are two firms who are identical by nature and they have different market values, then this situation will not last for a longer time, because at that point the arbitrage process will take place and it will set the difference between the market value of the both of the firms, and due to which the overall cost of capital will remain constant. Thank you.